One of the fastest ways to build net worth is simply reducing what you spend on discretionary purchases. The 1% rule gives you a framework. Think twice before any discretionary purchase that exceeds 1% of your net worth. If your net worth is $20,000, pause before any purchase over $200. At $50,000, that threshold becomes $500. At $100,000, it is $1,000. Here's why this matters mathematically. If your net worth is $20,000 and you make a $200 impulse purchase every month, that's $2,400 per year. It seems small, but $2,400 annually represents 12% of your entire net worth gone every single year on things that didn't require second thought. That same habit over 40 years, accounting for what those dollars could have grown into if invested, costs you over $670,000. One habit, $670,000 in lost wealth. Think about what triggers these purchases. A bad day at work leads to retail therapy. A friend gets something new and suddenly you need it too. A sale creates artificial urgency. Social media shows you products you didn't know existed and suddenly can't live without. These aren't rational financial decisions. They're emotional responses with permanent financial consequences. The 1% rule doesn't tell you never to buy anything. It tells you to pause and actually think. Sometimes you'll pause, consider it, and decide the purchase is absolutely worth it. That's fine. The rule did its job. You made a conscious decision rather than an automatic one. The 1% rule is most important when you're under $100,000 because that's when building net worth has the most friction. Every dollar matters more. Once you pass that threshold, you can relax the rule slightly, but by then you'll have built a habit of actually thinking before spending. A practical approach is to wait a week before any significant purchase. Time reveals whether you actually want something or whether it was just a momentary impulse. Most things you need on Tuesday don't feel necessary by the following Tuesday. Throughout life, unexpected money appears. Tax refunds, work bonuses, inheritance, side hustle income, gifts, cashback rewards that accumulate without notice, money from selling things you no longer use, rebates you forgot you submitted, the occasional stroke of luck. When these windfalls arrive, the wealthiest response is to pretend the money was never there and invest it immediately. Most people do the opposite. A $3,000 tax refund triggers thoughts about what to buy. A bonus feels like permission to upgrade something. An inheritance gets absorbed into lifestyle inflation within months. The money arrives, briefly increases the checking account balance, then disappears into purchases that felt justified at the time. Here's a realistic compromise. Take 10% of any windfall as spending money. Invest the remaining 90%. You still get something tangible from the bonus, a nice dinner, a small purchase, whatever brings you joy, but 90% goes toward your future self. Let's say you get a $3,000 tax refund annually and invest 90%, $2,700. Over 20 years at average market returns, that compounds to over $130,000, all from money you never expected to have in the first place. The psychological trick is simple. Don't let windfall money hit your regular checking account. Set up a separate investment account and route it there directly. What you don't see, you don't spend. People often underestimate how many windfalls they actually receive throughout a year. It's not just the big obvious ones like tax refunds or annual bonuses. It's also the smaller amounts. A $50 rebate here, a $100 gift there, cashback rewards accumulating on credit cards. Individually, they seem insignificant. Collectively, they might add up to several $1,000s annually that most people unconsciously absorb into regular spending. Increasing the gap between income and expenses sounds obvious, but execution matters. There are really only two levers: earn more or spend less. Ideally, both simultaneously. On the income side, the landscape has shifted. Job hopping, which used to reliably deliver 10 to 15% salary bumps, has lost most of its advantage in 2026. Recent data shows job switchers now see only about 4.8% wage growth compared to 4.6% for those who stay put. The difference has nearly disappeared. That doesn't mean you shouldn't pursue higher income. It means you need different strategies. Building high-value skills remains one of the most reliable paths. Skills that directly generate revenue or are in high demand but short supply. Data analytics, specialized trades like welding or electrical work, video editing, digital marketing. I've seen people double their income within 18 months by dedicating evenings and weekends to learning one of these skills. The key is identifying skills that companies will pay premium wages for because they can't find enough qualified people. Generic skills get generic wages. Specialized skills command premium compensation. Look at job postings in your field or a field you're interested in. Notice which roles pay significantly more than others. Then look at what skills those roles require that the lower paying roles don't. That delta between the skill sets is exactly what you should be learning. Negotiating your existing salary still works. One successful negotiation that adds $5,000 to your starting salary, followed by standard 3% annual raises over your career, is worth nearly $60,000 from a single conversation. On the expense side, there are three monster categories eating most people's income. The total annual cost of owning and operating a new car is roughly $11,500, according to 8RA's 2025 analysis. That's depreciation, insurance, fuel, maintenance, finance charges, everything. Nearly $1,000 monthly just for transportation. The average annual cost of owning and maintaining a home is over $21,000. Mortgage is separate. This is just maintenance, repairs, insurance, property taxes, utilities. The average vacation now costs over $7,000. International trips push closer to $10,000. These aren't arguments against cars, homes, or vacations. They're reminders that lifestyle choices have massive compounding effects. Driving a paid-off vehicle for an extra 3 years instead of financing something new might save you $30,000. That $30,000 invested grows to something much larger. Small optimizations in these big categories matter more than obsessing over coffee purchases. Cutting out lattes saves maybe $500 annually. Choosing a reliable used car over a new one saves $5,000 to $10,000 per year. Focus on the big numbers first. The gap between what you earn and what you spend is the only number that truly matters for building wealth. Widen it however you can. 67% of Americans don't track their net worth at all. They have no idea where they stand financially. Just vague feelings, sometimes anxious, sometimes optimistic, but no actual numbers. Tracking creates awareness. Awareness creates action. Calculating net worth is simple. Add up everything you own, subtract everything you owe. Cash, investments, home equity, retirement accounts, these are assets. Credit card balances, car loans, mortgages, student loans, these are liabilities. Assets minus liabilities equals net worth. I recommend tracking quarterly rather than monthly. Monthly can feel obsessive and market fluctuations create noise. Quarterly gives you enough data points to see trends without driving yourself crazy. The psychological effect is powerful. Seeing your net worth written down makes it real. Watching it grow, even slowly, motivates continued progress. Noticing it stagnate prompts investigation into what's leaking. There's also accountability built into tracking. When you know you'll be looking at your net worth in 3 months, you make different decisions today. That impulse purchase feels different when you know it will show up as a smaller number on your next quarterly review. Beyond just tracking the number, pay attention to the components. Is your net worth growing because your investments increased or because you paid down debt? Is it stagnant because you're not saving enough or because market returns were flat? Understanding the drivers helps you know where to focus your effort. You can't improve what you don't measure. Lifestyle inflation is what happens when your income rises and your spending rises to match it. You get a raise and immediately upgrade your apartment. Bonus hits the account and a new car follows shortly after. The problem isn't enjoying money. It's the automatic escalation that prevents wealth from ever accumulating. Someone earning $150,000 who spends $140,000 has a lower savings rate than someone earning $70,000 who spends $50,000. The first person might feel richer. The second is actually getting richer. This is why high earners often have surprisingly low net worth. Doctors and lawyers making $300,000 annually sometimes have less saved than teachers earning a third of that. Income got confused with wealth. Spending scaled with earnings. Nothing accumulated. The pattern is predictable. Income increases by $10,000. New expenses appear that coincidentally total about $10,000. A nicer apartment because you deserve it after working so hard. A car upgrade because you need something reliable. Nicer restaurants because your time is more valuable now. Each expense feels justified in isolation. Together, they consume every dollar of increased income. True fulfillment rarely comes from incremental lifestyle upgrades. Research consistently shows that experiences deliver more lasting satisfaction than possessions. The hedonic treadmill, where we adapt to new purchases and need bigger ones to feel the same excitement, is real and relentless. The wealthiest approach is to delay status purchases as long as possible. Drive the car that works, live in the apartment that's sufficient, travel strategically rather than constantly. Direct the gap toward investments and watch your net worth compound. Your lifestyle can expand eventually, just not at the same pace as your income. If your income grows by 10%, maybe your lifestyle grows by 3%. The remaining 7% builds wealth. Maximizing tax efficiency is about keeping more of every dollar you earn without earning additional money. Legal structures exist specifically for this purpose. Use them. Start with your 401k. For 2026, you can contribute up to $40,500 if you're under 50. If you're 50 or older, catch-up contributions allow an additional $8,000, bringing your total to $30,500. If you're between 60 and 63, a super catch-up provision allows $11,250 extra. Every dollar you contribute to a traditional 401k reduces your taxable income for that year. If you're in the 24% bracket, a $10,000 contribution effectively costs you only $7,600 after tax savings. If your employer offers matching contributions, contribute at least enough to capture the full match. This is free money, an immediate 100% return on your contribution up to the match limit. Not capturing it is leaving compensation on the table. I've met people who leave thousands of dollars in matching funds unclaimed every year. That's not a financial strategy. It's giving yourself a pay cut. IRAs offer additional opportunity. The 2026 limit is $7,500 with an extra $1,100 in catch-up contributions if you're 50 or older. Depending on your income and situation, a Roth IRA might make more sense. You pay taxes now, but withdrawals in retirement are completely tax-free. Inside retirement accounts, you can buy and sell investments without triggering capital gains taxes. This tax-deferred compounding is enormously powerful over decades. Every time you'd normally owe 15 or 20% to the government, that money stays invested and keeps growing. In taxable brokerage accounts, use tax loss harvesting strategically. If you have investments that are down, selling them realizes losses that offset your gains. You can immediately buy a similar investment to maintain market exposure while reducing your tax bill. Also consider HSAs if you have access to them through a high-deductible health plan. For 2026, you can contribute $4,400 for individual coverage or $8,750 for family coverage. HSA contributions are tax-deductible, grow tax-free, and can be withdrawn tax-free for medical expenses. It's the only account with a triple tax advantage. Most people leave significant money on the table by not optimizing for taxes. Don't be most people. You can negotiate far more than you think. Salary is obvious, but also utility bills, insurance premiums, medical bills, home repairs, contractor quotes, wedding vendors, rent increases, credit card interest rates, even gym memberships. Two things to understand about negotiating. First, it's uncomfortable. There's no avoiding that. You're going to feel awkward asking, but a 15-minute phone call to your insurance company can save $600 to $1,000 annually. Many companies have retention departments whose literal job is keeping you as a customer, and they have discounts available that you only receive by asking. I've personally watched people save hundreds of dollars just by calling their cable company, their car insurance provider, their cell phone carrier, and simply asking if there are any promotions or discounts available. The worst they can say is no. They rarely say no. The script is simple. Call, be polite. Mention you've been a loyal customer. Say you're reviewing your budget and considering alternatives. Then ask what they can do to help you stay. That's it. No confrontation required, no aggressive tactics. Just a simple question that opens the door to discounts. Second, the framework is universal. Know what you want, know what you'll accept, know what you'll do if negotiation fails. That's it for any negotiation. whether salary or cable bill. One successful salary negotiation at the start of a job can be worth tens of thousands over your tenure. Every subsequent raise compounds on that higher base. The discomfort of asking lasts 5 minutes. The financial benefit lasts years. Most people fail at building wealth because they rely on discipline for recurring decisions. Discipline is finite. Automation is permanent. Set up automatic transfers so that when your paycheck arrives, money immediately moves to where it should go. Investment contributions, savings account, bill payments. The money is allocated before you have a chance to spend it elsewhere. The psychology is straightforward. You can't spend what you don't see. Specifically, automate these 5 things: retirement contributions, savings transfers, bill payments, investment contributions beyond retirement, and debt payments above minimums. The beauty of automation is that it removes emotion from financial decisions. You don't have to convince yourself to invest after a stressful week. You don't have to remember that it's time to move money. The system handles it regardless of how you're feeling or what else is happening in your life. Think of it like paying yourself first, but without requiring any willpower. The money moves before you even have a chance to decide whether you feel like investing this month. Of course, you don't feel like it. Nobody does. That's why automation matters. Once the system is running, wealth building happens whether you're paying attention or not. You're not relying on remembering to invest or summoning discipline after a long week. It just happens. Set it up once, let it run forever. Check in quarterly to make sure everything's still working. That's the entire maintenance requirement. The return on financial education is essentially infinite because one good concept can snowball into better decisions for the rest of your life. Understanding compound interest emphasizes why starting early matters. Understanding tax efficiency helps structure investments properly. Understanding behavioral finance improves decision-making under pressure. Each concept builds on the previous one. Most of this knowledge is free. Books, podcasts, online content. You don't need expensive courses or paid mentors. The information exists everywhere. Be cautious of anyone charging significant money for financial education. The fundamentals are well documented and freely available. What you need isn't secret knowledge. It's consistent application of basic principles. Start with the classics. Learn how compound interest actually works by running the numbers yourself. Understand the difference between assets and liabilities. Learn why fees matter in investment accounts. A 1% fee difference over 40 years can cost you hundreds of thousands of dollars. Understand how tax brackets work and why people have such confused beliefs about earning too much. People who build wealth aren't necessarily the ones who earn the most. They're the ones who make better decisions with what they have. Financial literacy is the foundation of better decisions. Disconnect your time from your earnings when possible. Traditional employment exchanges, time for money. That's fine. Most people start there, but there's a ceiling. You only have so many hours, and even high hourly rates hit limits when lifestyle expenses grow alongside income. The alternative is earning based on results rather than time. Owning a piece of something, commission structures, equity stakes, investments, generating returns while you sleep. Building assets that appreciate. A realtor selling a $3 million house does roughly the same work as selling a $1 million house, but the commission is 3 times larger. The work was disconnected from time. This isn't about abandoning employment. It's about recognizing that wealth accelerates when income isn't capped by available hours. Side projects, investments, equity participation. These create income streams independent of your clock. Even small steps matter. Dividend-paying investments generate income while you're doing other things. A side project that earns a few hundred monthly compounds over time. Ownership stakes in anything, even small ones, participate in growth that hourly work cannot capture. The wealthiest people you know probably have multiple income streams. Some from active work, some from investments, some from ownership. They're not necessarily working more hours. They're capturing value from assets that grow without their constant attention. You don't need to quit your job to start this process. You just need to begin directing some portion of your earnings toward things that generate returns independently of your time. Here's what actually happens when you implement these strategies. You start with the 1% rule and notice how much money was disappearing without thought. Your discretionary spending drops. The gap between income and expenses widens. You begin tracking net worth quarterly. The number feels small at first, maybe even discouraging, but you watch it grow slowly, then faster as investments compound. You maximize your 401k contributions and see your tax bill shrink. You negotiate your insurance and save $800 annually. You automate everything and stop thinking about money logistics. A windfall arrives, bonus, tax refund, something unexpected. And instead of upgrading your lifestyle, 90% goes straight to investments. Your net worth jumps. Years pass. Compound growth accelerates. The number that once felt impossibly small becomes substantial. Then it becomes significant. Eventually, it represents options you never had before. Options to change careers, options to take risks, options to help family, options to retire on your own terms. The gap between average and median net worth exists because some people do these things and most people don't. The median 55 to 64-year-old has a net worth around $365,000. The average for that age group exceeds $1.6 million. Same jobs, same economy, same number of working years, different decisions. You don't need to earn more than everyone else. You don't need investment secrets or market timing or luck. You need the boring fundamentals applied consistently over time. Track your net worth. Widen the gap between income and expenses. Automate contributions. Maximize tax-advantaged accounts. Think before discretionary purchases. Invest windfalls. Negotiate when possible. Keep learning. Build assets that work while you sleep. None of this is complicated. All of it is effective. The question isn't whether these strategies work. The question is whether you'll actually implement them. 20 months from now, you'll either have a higher net worth than today or you won't. The strategies are here. The decision is yours. Start with one, master it, add another. Let them compound. That's how wealth gets built, not through secrets or shortcuts, but through principles applied consistently over time. The best day to start was years ago. The second best day is today. If this breakdown changed how you view your financial future, please subscribe and like the channel. We are uncovering the wealth-building strategies that the system often overlooks. Start planting the seeds of your financial freedom today. The next treasure chest of knowledge will open soon.